Thanks for attending this Murex Open Theater in SIbos today. My name is Didier Loiseau. I'm heading rates and credit trading in Murex. And I also happen to be co-head of the LIBOR discontinuation program. So today, I'm going to tell you a story. So no end of the world, no human genocide in this story, only the death of one number, or rather a set of numbers. This number, you know it, it's called the LIBOR. So like in every good story, in the beginning you have peaceful times, and then come problems, dangers, and fights. And we all hope that the good guys, which would be us in that case, are going to win at the end of the story. But we don't know that for sure, and that's what makes it so interesting. So this story is our story, and guess what? It has already begun. So just to start with, a summary of previous episodes. Where do we stand? LIBOR was first published in 1986, and its story is a story of success. It's published in 5 currencies, according to 7 maturities. Such a success that today, LIBOR is referenced in around 400 trillions, whatever that means, of US dollars around the world, across all business lines: cleared derivatives, non-cleared derivatives, loans, securities, etc., etc. However, so this number has been often called the world's most important number. And when you look at it like this, it could well look like the Incredible Hulk. However, in 2008, things started being a bit more complicated. And the global financial crisis and the subsequent LIBOR rigging scandals exposed 2 fundamental weaknesses in the world's most important number. First one, LIBOR is prone to manipulation. About 70% of LIBOR quotes, LIBOR publications, are based on expert judgment, whatever that means again. How safe is that? Second problem, LIBOR is not representative enough of the real economy. This number, that is the world's most important number, referencing 400 trillions of dollars, is based on hardly $1 billion of daily transactions. That's a ratio of 400,000 to 1. So if you look at LIBOR from this angle, it rather looks like Ant-Man. So what did market authorities and regulators do to address these problems? Well, they looked for ways to reform the rates benchmark, simply by replacing LIBOR, actually. So what are they looking for? They're looking for benchmarks which cannot be manipulated and which are representative of the economy. So what they have looked at, actually, is benchmarks which are based on underlying transactions, and a big amount of underlying transactions if possible, so that the rate is robust and representative. So when you're looking for such a rate, you rather look at the overnight rates, which are, in addition, almost risk-free. So that's what the regulators did. They chose some overnight rates to replace LIBOR. What they also did is they worked on mechanisms transition mechanisms that would facilitate the adoption of the new rate and help practitioners find the incentive to change their exposure from the legacy rates to these new benchmarks. So where are we now? These are the main currencies of the global markets. And for each of these currencies, an alternative reference rate has been found. It's an overnight rate, as I told you. So it means that, for example, on US dollars, the replacement rate for LIBOR will be the SOFR rate, or not exactly a SOFR rate, but a compounded version of the SOFR rate on 3 months or 6-month period, for example. So that's the compounded in arrears kind of setup. So we have the SOFR in US dollars, in euro we have the Ester, even though Euribor is not meant to be discontinued yet. And we have SARON for Swiss markets. In pounds, JPY, and in Australian dollar, the choice was made to keep existing indices, but to reform them, to make them more robust and more representative. So looking at this picture, it could well seem that we are close to achieving the transition. We have all the rates, at least in the main markets. So is it the end of the story? There are challenges ahead. it's not that easy. Finding the rates, first acknowledging that the LIBOR was weak, was the first step. Finding the rates was the second step, but it's not the end of the story. What needs to be done? There are challenges to perform the transition from these old rates to these new rates. So there are here, we list 3 of the main challenges. The first one is the challenge of adopting these new rates. Well, they exist, that's good. But are the markets adopting these new rates? It's not the case yet, and we'll zoom on that one. Second is how to manage the legacy transactions and the legacy positions. There are 400 trillions of exposure. There are many transactions, many positions, loans, securities, everything referencing LIBOR. What are we doing with those ones? And the third challenge is all the side effects of removing LIBOR. LIBOR is not only a rate that is referenced in contracts. It's used in valuation practice. You even have some other rate indices which through FX forwards are implied from the LIBOR. So removing LIBOR from the landscape doesn't just happen like that. We'll zoom on the first challenge, which is the adoption of the rate, which is one of the biggest ones. And we'll even zoom further on US dollars and the SOFR, which is the replacement rate. So let's look at the bright side first. You may read on the internet, on this or that article, that SOFR trading is picking up. It's true. Look at this trend. It's nice, right? This is the birth date of SOFR, or at least of the SOFR futures, which are made available by CME. There's a 1-month future and a 3-month future. And the actual trading volume has been increasing in a nice way since it was first created. That's what I would call the short end of the curve. And the short end of the curve is today fairly liquid, or at least the trend is a good one. So that's probably a reason to be happy. Let's continue looking at the bright side. These are FRN issuances, floating rate notes issuances. So bonds, which refer so far as the floating rate. This shows, again, a nice trend of issuances. More and more people around the planet are issuing US dollars bond, referencing compounded so far. That's also a good sign. And that's the end of the bright side. So now let's look at what is a little bit more painful. So let's look at the long end of the curve. Long end of the curve is swap trading. So where are we in terms of swap trading on so far? Well, the answer is easy. We're nowhere. This is the weekly trade count since the creation of the cleared swaps on the clearing houses. There's a huge peak of 65 trades on a given week. I'm kidding, of course. This is incredibly low. And we can even compare it to its cousin, the LIBOR. If you look, that's from a date somewhere in the middle of 2019 year, and that's the number of trades from 1st of January to this date. What you can see is that while USD LIBOR was traded in about 500,000 swaps around the world, at the same time, SOFR was traded in a few hundreds of swaps. So what does that mean? That means that there is no swap market on SOFR yet. Liquidity has not picked up, and that makes any transition impossible. No one will start rebalancing their positions from the LIBOR to the SOFR if there's no market, if there's no liquid quotes, and there's no curve on the long end. So that's one of the main challenges we're facing today. And we'll see later on how we plan to address it. So there are challenges. Now what comes next? What are the next chapters of this interesting journey? This is, if you want, a kind of summarized timeline for the years and the months to come. If I have to summarize it, 2019, for the few weeks and months until the end of December, a lot of things are going to happen on the euro side. A rebenchmarking of the euro market, the Onion Euribor, we're going to see that. Next year will be the big year of the discounting switch. CCPs, CSA repapering, there will be a change in the PAI and the collateral interest calculation, and that will drive a change in valuation and discounting. That will be for next year. And in 2021, well, transition will need to happen. Because at the end of 2021, that's actually the earliest possible date, but we'll need to get ready as if it was the real date. So at the earliest, indeed, but at the end of 2021 or beginning of 2022, LIBOR could cease being published. And we have to get ready for that. So let's examine each of these steps a bit more in details. 2019 first. 2019, as I said, Euro benchmark are getting ready. Starting with the newcomer, Esther. By the way, Esther is going to start being published next week. So what's going to happen? On the 2nd of October, which is Wednesday next week, Esther will, Ionia will become locked to Esther. By rule, Ionia will be equal to Esther plus a fixed spread of 8.5 basis points. Esther being fixed, being known on the next day, the day at T+1, meaning the day after the value date, it means that Ionia, from next week, will also be known by this fixed spread rule at T+1. So what's the impact of that? So first, there will be practical operational impact in terms of valuation at the end of the day, in terms of operations of that collateral payment at the end of the day. You will know the Ionia just the next day. So that's something that needs to be prepared for. I guess we all prepare for it already, but it's worth mentioning. And just to comment on the transition path that was chosen on that one, it's quite a smart transition path if you think about it. This fixed spread thing allows to avoid any dispute in the value transfer or any difficulty in CSA repapering. I had a CSA referencing Ionia. It's OK. Let's reference Esther plus 8.5 basis point. It's equivalent. So that's really an interesting path for the transition that was not followed by LIBOR, for example. So that's the first step, and it's happening next week. Next comes Euribor. To become BMR compliant, we are going to migrate from Euribor to the hybrid methodology for Euribor. One of the consequences of this is that, again, Euribor is going to be known at T+1. We could say, oh, that's OK. It happened in Sonia last year. It will happen in Ionia, Esther next week. It's just another one. It's true, but the impacts in terms of end-of-day valuation and risk calculation will be much more important, because one fixing of Ionia and not knowing it, so the assumptions you make on the level of the fixing are much more impactful than just one Ionia fixing that is averaged out in a whole period. So that is something that we all need to prepare for as well before it's actually implemented. So that's for 2019. That's going to keep us busy for the next month. What happens next year, 2020? As I said, discounting overhaul, change in PAI calculation, and a hope for liquidity on the long end of the curve. What does that mean? Next year, CCPs, again, I'm going to zoom on US dollars here. CCPs, such as LCH and CME, have announced the moment when they are going to change their PAI calculation. I remind you, PAI is the interest on the collateral posted. So today, PAI for US positions is calculated using the Fed fund rate. Next year, on the 17th of July for CME, on the 17th of October for LCH, the PAI for cleared trades is going to be calculated using SOFR. The change will be extremely important. So when this happens, first, the clearing houses have plans to organize the cash compensations between the various clearing members to account for any valuation difference, because that will drive a discounting change. So they will organize this cash payment, and they will also book some basis swaps to avoid any disruption in the risk profile when the transition happens. That's interesting. But from the moment they do that, the whole valuation framework of linear rates derivatives is going to change. And the discounting, the main discounting for all the clear trade is going to change from Fed fund to SOFR. That's going to be a big, big impact. What it's going to trigger as well, everybody counts on that, is more liquidity on the long end of the curve. From one day to the other, everybody will have exposure from the discounting of the cleared trades to the long end of the curve. Everybody will want to hedge, and that will create liquidity on the long end of the curve. That's what people think. That's what I think as well. If you remember OIS discounting, it used to be the same. After the crisis, we went for multi-curves. Everybody wanted to do OIS discounting, but there were some concerns that, you know, after 2 years, there was no liquidity in the OIS market. Same situation. But then the CCPs kicked in, and they all calculated API on the OIS rates, which created a liquid hedge market and then liquidity on the long end of the curve. If you use this comparison, you can well imagine that the same thing is going to happen on SOFR and on the reference rate. And we do expect more liquidity on the long end of the SOFR curve starting next year, which will allow us to start envisaging a transition. Probably still in 2020, when this whole thing on CCP happens, which we can call the discounting switch, probably CSAs will start to be renegotiated. It means that people will start dereferencing from the CSAs indices that will be discontinued, of course, starting with Ionia. Ionia could already start now, actually. LIBOR, and starting, and probably Fed fund and such rates will be dereferenced in favor of SOFR. But this will probably start happening only once the cleared trades will be addressed and the whole discounting framework will change for the cleared derivatives. But that's going to start probably next year, at the end of next year. And that's for 2020. Let's look at 2021. In 2021, transition must happen, i.e. we will need to start dereferencing all the LIBORs and start referencing the new rates. How is it going to happen? Let's start with bilateral with OTC derivatives and bilateral in general. On the cleared derivatives, CCPs will probably orchestrate the whole thing. So let's put that aside. Let's speak about bilateral trades. For bilateral trades, several mechanisms exist. There are the usual channels. You can do compression, compress your existing exposures on the old indices, and then replace them by the new rates. You can simply terminate position and open new position when you have the luxury to do that. And then there will be other possibilities. Bilateral agreement to transition from a legacy rate to a new rate, or in some cases, some pre-cession clauses will exist in contracts that will force a transition in case an index is deemed as not representative enough. There's no clear view on what the favored approach is going to be. It could well be that all the approaches will coexist, but we'll need to be ready for all these various events. Looking at the cash products for a second. So I'm talking here loans and securities. The ARC is actually coordinating working groups around this topic. And they have proposed fallback language with clear trigger clauses to address the question of cash products, loans and securities. They proposed, in addition to the pure secession of the index itself, they proposed two additional kind of clauses. One clause is the pre-secession mechanism, in case of non-representativity of a benchmark. Another one for loans is a possibility to adopt a new rate before the secession happens. What's very important to notice today is that if you look at the proposal from ISDA and from the ARC, they do not reconcile. And today, the consistency between the cash products and the derivatives is not guaranteed. And we could well have discrepancies if we look at things today. That's one of the main concerns of practitioners when looking at all this transition thing, is the possible lack of synchronization between the various product lines. So of course, more consultation, more discussion will need to happen in the coming months and years to reach a situation where everybody feels comfortable to perform the transition. And then, at the end of 2021, comes the deadline. Ionia will certainly be discontinued on that date, but because of the smart transition path that was adopted on that front, it will be quite easy. On the LIBOR, again, end of 2021 is the earliest date. We don't really know when this is going to happen. It could happen at another date, but we have to be ready for that time. And there are still a lot of unknowns, as I mentioned. What about securities which on that date, floating rate notes which have been issued without any fallback clause? What's going to happen to them? What's going to happen to derivatives if the new ISDA protocol that is due this year is not signed? There's no fallback language to refer to. So there are still a lot of unknowns, and it will be essential to follow up on everything that happens until then to not to be left behind. So maybe just a little question. What's the role of technology in this whole picture? Will it be a hurdle? Will it be an enabler? Of course, it can be both. Technology will be an enabler under the following three conditions. First, technology must enable the trading on the new instruments and the corresponding curves. And that's not trivial. All these new products, all these new indices come with the change in trading practice, that is the nature of the instruments, and it's important to account for them from a technology perspective. That's one aspect. Second condition. It's important not to go through this turmoil blindfolded. No one wants that. A lot of things are going to happen, and we need to be clear on the impacts it's going to have on the various business processes and activities. So technology has a role to play to help practitioners anticipate the impacts from a qualitative and quantitative perspective. That's the second condition. Third condition, well, when all these changes happen, be it the discounting switch on CCPs next year, the transition, the fallbacks, the secession, pre-secession, well, that's events that need to be modeled in the technology, need to be represented in the technology. So you need to have a technology that's able to cope with all these changes that are going to come. So, as a conclusion, so how to make sure that the good guys are going to win in the end? So first, sorry to say that, but unlike in the movie, time travel is not an option. So you have to do without that. Second, we will need to succeed as a team. It means that all the changes that I have listed before for a capital markets institution are changes that don't happen just in one department. It's not just the business, or it's not just the IT. It's all at the same time. So any institution to succeed throughout this journey has to work as a team and to gather all various expertise in order to be able to action a consistent and smooth change. Three, we will need to adapt to the evolving situation. The only thing that we shouldn't do is stick to the old practices, stick to the old framework. What we need to do is embrace change, because adaptation is going to be essential to win this battle. And I'm done. Thanks for your attention.